The stock market is one sexy playing field right now. Not only are markets down to historically cheap prices for buying, but volatility is through the roof. The markets are all over the place.
Good news sees a tick upwards, but bad news sees a tick downwards. The draw towards day trading in such times is strong. Check out what happens if the stock market moves up and down by 2% over a 10-day period. If you always bought at the bottom of a down day preceding an up day, you'd make 5 lots of 2%, 10% in 10 days.
That would be a good return for a whole year for a long-term investor. And in this example, you could have done it in 10 days by day trading. Keep that up for a whole year and you'd return 3,700% with compounding. £1,000 would become 37 grand.
So why isn't everyone doing this? Well, it's not as easy to get right as you might think. The highs and the lows of a share price are easy to see in a historical graph, but there is no graph that will show you the share price for tomorrow, or even an hour from now.
Today we're looking at day trading versus long-term investing, the best way to go about day trading, and if long-term investing actually gives better returns. Let's check it out.
Welcome to Unshackled.com, the investment and finance channel and website that sets you and your finances free.
That was Andy and I'm Ben, and if you like what we say, hit the like button and click subscribe. Investment app Freetrade are giving a randomly chosen free share to each new customer who opens an account using the link on the offers page at Unshackled.com. It could be worth up to £200. By using this link and the others on Unshackled.com, you are helping to support the channel and allowing us to make more videos, so a massive thank you to those of you who have already done this. Now, let's get into the video.
Why day trading? Short-term trading has the potential to be highly rewarding. It's more exciting and hands-on, and the potential for fast and high returns may just attract some investors. Who doesn't like fast and easy money? So why isn't everyone chilling on their private yacht in Miami having played around with day trading for a few weeks? Well, market timing is very difficult to do.
You have to be right twice. Once when you buy the stock, and again when you sell it. Day trading does have the chance to make you very rich, and we'll get to the best way to go about doing that. But first, let's look at the problems with it.
What stops you winning at day trading? Day traders are focused on return, not risk, but day trading is riddled with risk. The risks involved mean that for most people, on a risk-reward ratio, it is likely to be less rewarding than long-term investing into a decent global portfolio. There are two major problems for day traders.
Number 1, trading fees. The traditional stumbling block for a day trading strategy is trading fees. At around £10 a buy and £10 a sell, trading fees on the premium platforms such as Interactive Investor and Hargreaves Lansdown make day trading almost pointless but for the richest of investors. Even if you're using CFDs or spread betting to trade, these are riddled with all manner of fees.
The free investing platforms such as Freetrade don't have this problem. There are no trading fees, but even on these platforms you still have to contend with stamp duty and the bid-offer spread. All shares have two prices, a buy price and a sell price.
The difference is called the spread, and this is the amount of money you would lose if you bought a share and immediately sold it. High street retailer Marks & Spencer has a fairly tight spread of 0.15%, while smaller companies on the UK AIM index can have much chunkier spreads, like the 6.25% of City Pub Group. It's the kind of cost that really stacks up if you trade frequently, but as a long-term investor, you might barely notice.
Number 2, timing the market. Let's imagine a day trader who sunk his fortune into shares in the FTSE 100 on the 26th of February 2020 after markets crashed massively from around 7,500 in the days prior to 7,042. This would be a reasonable action from a day trading perspective, but day traders can no more see the future than the rest of us, and could have no idea that the months following this day would see the markets drop off a cliff.
This day trader would have gotten half of the equation right at least. He would have bought low relative to recent highs. But unfortunately, you have to get the sell high part right as well.
If you insist on day trading, how to lower your risk. How we would approach day trading is exactly the same way that we would approach poker. We'd never put more than a 20th of our total pot into any one transaction. Definitely don't draw on all your savings to day trade. Only trade what you can afford to lose.
The risk to a day trader is that the market doesn't go up higher than the price you paid for it for a very long time, effectively transforming your trade into a long-term investment. We like to invest for the long term, but the kind of volatile stock that you might choose as a day trader is not necessarily the same type of investment that you would pick if you were a long-term investor.
So, you could pick a stock that you think is volatile enough to rise quickly in the short term, but when it is lower than in previous days, and put in no more than a 1/20th of your pot. If you're right, it's a quick win. If you're wrong, you have to decide whether you're going to keep the stock for the long term or sell at a loss. And selling at a loss is an emotional hurdle to overcome. You may end up selling your winners straight away, but holding duds for a long period of time. By dividing your total part into at least 20 parts, you could spread your risk over at least 20 trades.
Day trade using ETFs. The biggest risk with shares is that they can go all the way to zero. And this is particularly so for a day trader who is trying to make a quick win on a falling share price that they think might recover. Maybe there's a reason the price is falling. Maybe what you're buying is a company that's about to go bust.
When we look to make profits from a falling market, we buy ETFs. They are diversified across many companies, so the risk of it going to zero are slim to none. And we hope to make our profits when they revert back to their intrinsic value. Maybe we'd lose everything if a meteorite hit the earth, wiping out all these companies at once, but then we'd have other things to worry about.
Long-term investing advantages. We like to model our shares investing strategy on that of Warren Buffett, legendary long-term investor. He returned around 20% per annum over his investment career.
Here are 3 key advantages to investing for the long term over day trading. Number 1, passivity. Being a day trader is a career. You need to be constantly hooked into the matrix, aware of price movements happening in real time and poised over your keyboard ready to take advantage of multiple micro gains to make your profits worth the effort.
We can't be bothered with all that. We'd rather be sat chilling and letting our global investment portfolio do the hard work for us, and we can say that happily because of point 2. Number 2. Long-term does better on average. Long-term investing weighs risk against returns and does better on both counts. Risk is reduced if you drip your money evenly and at regular intervals into the market, as the highs are offset against the lows and you end up investing at an average price.
In a famous study of individual investors' behaviour, Berkeley University professors Barber and Odin found that most active traders realised the lowest returns. Their 2017 study found that 80% of active traders lost money, and only 1% of them could be called predictably profitable. Maybe some of our viewers fall into this 1%. If so, let us know.
Whereas long-term investors should average the returns of a global stock market, which has always gone up over the long term and up big.
Number 3, dividends. Dividends are what turn a long-term investing portfolio into a passive income generating machine, and is a key reason why long-term investing beats short-term trading. No matter the swings in stock prices, dividends across your portfolio will likely continue to get paid.
Investing during a recession gets you the best of both worlds. You're buying when the market is down, locking in a cheap price, and you can hold on to your assets for the long term, reaping sweet dividends as you go. And the lower the stock price, the more you can buy, meaning the more dividends you get.
Question of the day: do you trade frequently or invest for the long term? Let us know your success stories in the comments below. Thanks for watching. On this channel we talk a lot about personal finance, investing and all things money. And if you want to see more great content, please click the subscribe button below.
This is MoneyUnshackled.com. See you next time.